So word on the street is that Alex Hormozi just made $100 million on his new book launch. Now, everyone knows that if you made $100 million, that sounds like just revenue, and that you also have expenses on top of that. So let's just assume he had around 70% of operating expenses, as well as ads and other things that kind of went into it. So let's just say he walked away with $30 million in complete profit. How would I go about offsetting that? So the very first thing we're gonna do is, if we have $30 million of profit, let's crank out an estimate and figure out what is your tax liability if you do absolutely nothing else. And that is our first starting point. Roughly, if you got $30 million of profit, I would expect the tax liability to be like what, $13 million, let's just call it. So let's just say he's on the hook for $13 million. First, we're gonna look at what can he do to expand his actual business. Does his business need real estate? Does it need more advertising? Does he need to hire people? That's the first thing I would look to do is, now that we have excess cash on hand, let's look to reinvest back into the business and look to grow this thing even more than what we already have. Now, of course, whenever you start talking about real estate, we do need to look at the passive activity loss limitations, and we need to make sure that the real estate is very specific to the function of his actual business in order to use those losses to offset his income. Because if he just goes out and gets a rental property and just sticks a family in there to rent it out, he may be subject to the passive activity loss limitations unless him or his wife is a real estate professional, which from the looks of things, it looks like they spend more than half of their time working on their business than they do on actual real estate. So real estate professional status is kind of out the window. So the only thing he can do is actually look to invest in real estate for his business, or maybe he does a short-term rental or something like that. But again, material participation, we would probably want to look at growing the business. So that's probably the area where I would look. If we're gonna get real estate, machinery, equipment, invest and get more employees, hire more people, spend more on advertising to just grow the business, that's where I would look first. Now again, on the flip side, there's more to a tax return than just what goes on the business side. We can look at his itemized deductions. Maybe we can try to max out his charitable giving. You can utilize things like DAFs, donor advised funds, to maybe shell away some of the stock they may have and use that to donate, and maybe use some of the cash to then reinvest back into the stock, and he can increase his cost basis. That way the capital gain may go away, and then he can take those funds and transfer it over to a charity of his choice. Now this is a lot of money on the table. Can we get the $12 million tax bill down to zero? I mean, I guess in theory you probably could, but you'd be taking on a lot of risk, and you'd also possibly be taking on a lot of leverage. Right, so that's one of the things that Alex and his wife would have to weigh between themselves to see if the risk was actually worth the reward. In my experience, we generally try to knock that tax liability down as much as possible, get tens of thousands, maybe hundreds of thousands. In Alex's case, he has millions of dollars of potential tax savings, so maybe he could save several $million with some really high-level tax strategies, but he's gonna have to really get in depth, and if I were him, I would not risk too much. We just want to knock that tax liability down to where there's a decent amount of savings, and we don't want to go broke trying to pay $0 in taxes.